Why cash out DSCR loans matter for real estate investors. Most real estate investors don't get stuck because they make bad deals. They get stuck because they run out of options at the wrong time. Cash out DSCR loans matter because they keep investors moving when personal income changes, when capital gets trapped, or when the market pauses. I want to walk through 3 real situations where cash out DSCR wasn't about pushing leverage. It was about creating options and buying time. Traditional refinancing is built around the borrower, income, tax returns, employment history. That system works until life changes. Cash out DSCR shifts the focus back into the asset. The question becomes simple. Can the property service its own debt? That distinction is why DSCR matters for investors who already understand real estate and want their portfolio decisions separated from personal income volatility. I'd like to tell you a story about a client I've worked with for several years. She and her husband own 9 short-term rental properties, all performing, all held in their personal names. The portfolio was built deliberately over time. She came to me because she wanted to start accessing equity from those rentals to acquire additional properties. At the same time, her husband had been laid off from a high-paying W-2 position and was about a year into a new self-employed career. Anyone familiar with lending knows what usually happens at that point. Instead of reacting emotionally, she wanted to understand her options. We looked at a cash-out DSCR refinance. The facts were straightforward. 12 months of documented Airbnb income, strong rent rolls, debt service coverage ratio comfortably about 1 to 1.25. Because the properties could service the debt on their own, she was able to pull 50% equity from an $800,000 short-term rental. The lender did not underwrite personal income. They underwrote property performance. She already had an LLC in place. She knew her operating numbers. She understood how risk would be evaluated. The solution wasn't forcing a deal. It was choosing the structure that matched the asset. She's now planning to expand further by responsibly recycling equity from existing rentals instead of waiting for personal income to stabilize. That's where cash out DSCR works well. It keeps growth tied to assets, not resumes. Another client of mine, this situation involves a real estate team based in Utah. They purchased 2 rental properties in North Carolina near a college town. Both properties were purchased with cash. Both required renovations. They understood the tenant base. They bought at a discount. The plan was for long-term rentals tied to the university nearby. Coming from the conventional lending world, they assumed they would need to wait 6 months before accessing any of the equity they created through the rehab. That assumption is reasonable. Most lenders limit refinancing during the first 6 months to the lower of the purchase price or appraised value, whichever is lower. That would have left their rehab capital idle. Instead, we structured a cash-out DSCR refinance. The work was documented. Receipts were clean. The improvements were supported by value. With certain DSCR lenders, seasoning is not required when the improvements are verifiable. The underwriting focused on future value, not just original cost. Both properties refinanced at higher values, and the team recovered all of their rehab capital immediately. This didn't increase risk. It improved capital efficiency. The solution here wasn't leverage. It was timing. For investors who buy correctly and execute renovations properly, time is just as valuable as money. Cash out DSCR kept their capital moving immediately instead of sitting on the sidelines. The third example shows a different use case. This client owned a property in Austin, Texas. She had the home listed for sale. As values softened, the price she wanted didn't materialize. There was nothing wrong with the property. There was no for sale, just the market timing. Instead of reducing the price, she came to me to explore a cash-out DSCR option. There was no tenant in place, no active lease, and the property had recently been delisted. Traditional financing would not entertain that scenario. With DSCR, there was still a path. Certain DSCR lenders allow recently delisted properties to qualify for cash out with a modest adjustment. In this case, it required a 5% reduction in maximum loan to value. We ordered a new appraisal. We obtained a 1007 rent schedule based on long-term rental comparables, even without current income, even without a tenant, even with a recent delisting. She accessed the cash out and got the proceeds that she needed. More importantly, the pressure to sell disappeared. She chose to rent the property again and let the market normalize rather than locking in a discount. The solution wasn't forcing an outcome. It was creating flexibility. DSCR didn't force a decision, it bought time. What do you think these stories have in common? None of these situations relied on projections. None depended on personal income workarounds. None were speculative. They worked because the properties could service their own debt, documentation matched reality, the structure matched the goal. Cash out DSCR works best when investors understand their numbers and want flexibility without interrupting momentum. It isn't a shortcut, it's a structured tool. Cash out DSCR loans aren't about doing more. They're not about being forced to stop when income changes, capital gets stuck, or markets pause. Used correctly, they preserve options. Used poorly, they add pressure. The difference is always structure and documentation. If you're an investor, where are you running into friction right now? Access to capital, timing, or uncertainty around the next move? Drop it in the comments below.